Hello and welcome to Livewire's ongoing reporting season C-suite coverage. I'm Hansley, and joining me today is Aidan Williams, the CEO and co-founder of Audinate, which recently reported its first half results. Aidan, welcome to Livewire. Great to have you here.
Yeah, thank you. It's a pleasure.
So for those who are maybe less familiar with what Audinate does, tell us about what you do and what makes you and the company unique within the Australian listed technology sector.
Audinate is a technology company. So we make networking technology that we sell to manufacturers of professional audiovisual equipment. So our customers are, it's a B2B business. Our customers are the likes of Yamaha, Bosch, Bose, people like that you've heard of, but also a whole load of other manufacturers who make audio, like amplifiers, speakers, screens, cameras, things like that for the audiovisual industry that many people wouldn't necessarily be aware of. Regarding sort of ASX comparisons, it's always a bit tricky, and I sort of don't want to be casting aspersions on other
No, of course,
ASX listed companies, but I think one of the things there's a few things probably that are different about Audinate. One is, we're absolutely a global company. So our technology, less than 1% of our revenue comes from Australia because most audiovisual equipment is manufactured elsewhere. I would say that we're absolutely a very kind of effectively sort of deep tech company in the sense that we do hardware, software, electronics, embedded stuff, all the way up through to sort of cloud-based services. So we're not like a retail portal, and we're not like a payments company or something like that. We've literally got this hardware, software, deep engineering thing going on. And I think probably the other thing which maybe investors like about us, from a business perspective, is that kind of hardware, software like connection that we have. Is like hugely scalable. So if we get designed into a shed load of amplifiers, then our business has an enormous amount of operating leverage associated with it because the networking technology proliferates, and then the more that we get out there, the more people pile on the bandwagon. So it's got some nice properties like that.
Yeah, well, that's fascinating. Thank you for sharing that with us. Let's turn now to your results, beating estimates on all fronts. What are some of the key figures that investors should be aware of?
We had a cracking half. There's no doubt about that. So from a top line point of view, the revenue, 46.6 million Australian, was a fantastic result. I think the highlight from that, I think, is we've been saying for a long time that we've got good operating leverage in the business. So, and we've also been saying that, with all the chip shortages that there've been in the past, it's like the demand is still there. Trust us, the demand is still there. So I think this half really shows that we've been able to deliver a bunch of that pent-up demand. That's translated to revenue, and then that revenue has dropped through to EBITDA. So it's sort of demonstrating both the demand side of things and the operating leverage in the business.
Well, let's talk about that leverage then, because obviously it shows up in gross margins, increasing to nearly 72% in the half.
Yeah.
But what has to go right for these margins to stay where they are, even improving further?
Yeah. Well, interestingly, actually, getting to 72%, that's like on the way back to where we were previously. So historically for Audinate's, the business that we have effectively for embedding our technology into pieces of audio and visual equipment, we've had gross margins that really represent more of a sort of software business of 75, 76%. So what happened was that during the pandemic, we had all these chip shortages and things like that. So we had increases in costs associated with chips. We had things that were unavailable. So we had to design around unavailability of chips. So we chose to prioritise availability of parts. So we paid a bit more for parts at the time, and that affected our gross margin. So now that the chip shortages are all behind us, now it's time for us to tighten the screws on the cost side of things. And so we're seeing that improvement in margin is a result of us going through that process. Albeit for this half, it was held back a bit by the fact that we were delivering a huge number of these Ultimo parts, which are our 1 to 4 audio channel chip solution that we have. That has a relatively low margin, so that kind of put a drag on our margin. But over the next half and into next financial year, I would see us increasing our margins as we work through bill of materials cost reduction in some of our major products, but also mix shift. So, having fulfilled the low margin Ultimo chips, we can get back to a more sort of normal, software and higher margin products, and that should bring our gross margin back up towards the historic margins we've had in the past.
You mentioned chips a few times. Let's turn to this story around the chip glut. It's been such a fascinating story over the last few years. So you say that those supply challenges have now receded or started to recede on your business. I guess, how do you know that, and what effect did those challenges, when it occurred, what effect did they have on your business?
We just had to manage through it. So we were doing absolutely everything we could on the way through in terms of trying to maintain supply. And it really is an exercise in, like, if you thought toilet paper hoarding was bad, like it's all the same stuff. So we're supplying chips, or alternatively we run on chips that are needed for people to implement our technology. So we found ourselves playing, role as either supplier, aggregator of demand, brokers, managing, you get so many toilet paper rolls, you get so many toilet paper rolls. So, that was just no fun. So absolutely a pain in the backside. The other thing that happened was, during that, because it was a supply shortage, prices went up. So we were in this position of needing to pass through price increases. So I think that's actually been good for us, because it kind of caused, historically we've generally kept our prices pretty static. And I think that worked in a relatively low inflation environment. But the chip shortages came through, prices went up, then we had to put through price increases. Yep. And I think now, in a more high inflation world, I think one of the things for us internally is to keep our eye on just making sure we continue to exercise that price increase muscle, over time. So I think that's one of the outcomes as well for us.
Yeah, no, absolutely. Speaking of backlogs, the one thing that I did notice in your results was the order backlog. How is that backlog now tracking?
Yeah, so our order backlog actually is reducing over time, and that's also got to do with the kind of chip arrangements. So pre-pandemic, a manufacturer of, say, amplifiers or speakers, they'd put an order in with, they'd basically say, I want this to be delivered in 2 months or 3 months' time. So we had about 2 to 3 months worth of visibility. But when chips suddenly became scarce, then people started to put their orders, they needed to put their orders in 6, 9, 12 plus months out. Yep. And what they're really doing is reserving their place in the queue, is what they're doing. So during the sort of pandemic and the chip shortages that we had, our backlog visibility kind of stretched out 12 plus months. So we got all this visibility over what's happening. So I think what's going on at the moment is, as chip supply is back, then naturally that sort of visibility and that backlog declines. The reason why we talked about it, though, in our results is that there's a little bit of sort of confounding variable, because for us, when we think about the full year results, so this half and maybe what's going to happen into the next financial year, things like future orders are obviously, that's a big deal for us. We pay attention to what our future orders and what our backlog looks like. So we're having a hard time really sort of disambiguating between the fact that backlog is naturally shrinking back because of supply chain issues, and we can't quite tell the difference between that and softness in demand. And when we look at different market segments, a few months ago, towards the end of, maybe it was November, December, we had some survey data coming back from one of the industry bodies that was a bit soft in the US, and so that caused us a little concern to sort of wonder where we were going. But I've just come back from a trade show in Barcelona in Europe, and that was just gangbusters. So there were more exhibitors than I've seen, more record number of attendees. So on the European side, that seems to be going well. So we have these mixed signals. So from my point of view, I feel like backlog will probably go back towards what it was like pre-pandemic. I don't think it'll go all the way back to 3 months, but I also know we've had a cracking half I expect we won't have the same revenue growth in the second half. So normally we have this sort of 45%, 55% split for the year. That won't be how it'll pan out for this year, I think, for the full year. But, you know, I'm optimistic that our second half, you know, there's very unlikely to have sort of downside risk, but we won't repeat the same level of growth we had in the first half.
Yeah, no, understood. One last thing that I wanted to ask about from that results release, you talk about seeking M&A opportunities. So I'm curious, can you reveal any opportunities you are pursuing right now, or at least want to share what you're after?
Yeah. So it's of great interest for many people, because we did a raise not that long ago, actually, again towards the end of last year. We have a fantastic audio business. Our video business is actually relatively new, and the video business has actually gone really well. We've tripled the number of products we have in market, like, you know, than we had 12 months ago. So it's going well. And we also have like this vision to deliver a kind of platform. So ultimately, we're engaged in a land grab at the moment, but we think the real value in Audinate is this software platform in the future. Mm-hmm. So the raise was about winning in video and establishing the platform. We've got like at least one large transaction that we're in discussion with at the moment. We've got 3 or 4 other transactions that we're working on like actively, and one that we've completed some pretty active due diligence on the video side of things, including, you know, I visited and, you know, saw the habitat and stuff like that. So we went fairly deep, but we haven't gone ahead with that transaction. We were unable to agree on a price effectively that was acceptable. So watch this space.
So that naturally leads on to this question. If you've got, you know, 4 or 5 transactions potentially on the go, again, as you say, you did the raise, you know, late last year. Do you see the need to be raising capital or to be taking on more debt to fund those M&A plans?
Yeah. So no, I don't think so. So I think we are well capitalised to get a larger transaction away if we want, or alternatively several smaller transactions which we can kind of jigsaw together into what we need, or maybe a combination of both. So at this stage there are no plans to raise any further capital, and historically we've been we haven't had debt in the business. So we do look at debt from time to time, and certainly from the, you know, debt versus raising capital, that type of thing, but there's no plans we don't feel the need to get more capital or access to debt in the short term at least.
Yep, all right, understood. We talked a little bit about revenue growth in terms of, you know, potentially maybe slowing down a little bit in that second half. Let's talk about profitability and margin goals that you have for the company for the rest of 2024.
Yeah. So for the full year, we've really been reiterating, you know, our guidance at the start of the financial year. So one of the transitions that's happening in our business is we're moving from hardware-based chips, cards and modules to a more software royalty type business for embedding devices, embedding the Dante technology into, say, an amplifier or a speaker. So what that means is, as we shift from a hardware product which has COGS in it, like, you know, manufacturing costs and chip costs, to just getting paid for our IP, we expect to see like a moderation in terms of revenue growth, but we expect to see our GP dollar growth continue to grow. So that's like a structural change in our business as we move more towards delivering our technology in a software form, as opposed to putting it in a chip or a module. So our guidance really was around GP dollar growth. So we're really, I get this result. What we're basically saying is, we had a cracking first half. Don't get too excited. And we're on track to actually deliver our original forecast for the full financial year, which was GP dollar growth in that sort of 25 to 32% range. So, you know, we're not, again, I think I said earlier, sort of we don't expect to be surprised on the downside of that, but we're still in that ballpark. And on the margin side, or, you know, so GP dollars, I think, translates to profitability. And so if you look at our current result, you can see that there's a pretty direct translation from, you know, the additional EBITDA or the outperformance that we had direct through to operating cash flow. And so, the other thing I think we're kind of guiding to is that we do expect margin to improve, over the next half, albeit not back to that 75%, 76% that we had previously, but we do want to make further inroads into that margin as we take cost out of parts of the business.
Aidan Williams, CEO and co-founder of Audinate. This has been a fascinating conversation. Congratulations on the result, and thank you for joining us here at Livewire.
Thank you very much.
And thank you for joining us. We hope you enjoyed the interview, and we hope you're enjoying all the interviews that we're doing for C-Suite reporting season coverage this February. If you enjoyed that, please subscribe to the Livewire Markets and Market Index websites and our YouTube channel. Thanks for watching.